So venture capital firms exist based on capital made available by what are called limited partners. Without LPs, venture capital firms would not exist. And limited partners or LPs include institutional investors like pension funds, asset managers, foundations, family offices, sovereign wealth funds, insurance companies, sometimes even the investment banks. And what LPs will do is they'll channel some of their capital to VCs so that they can diversify their portfolios. And they hope by investing in venture capital, they can generate returns that are higher than a specific market index like the S&P 500, the FTSE, the JSE Top 40, for instance. Asset managers call this ability to generate excess returns alpha. So many LPs will seek to generate excess returns of, say, 500 to 800 basis points relative to their chosen index. That effectively means that if the JSE generated a 12% return, LPs would be aiming for a 17 to 20% return from their VC portfolio. So the overarching goal of the LPs is to earn a return on their money so that they can fulfill whatever mission they've defined. Generally speaking, the types of investments to which LPs allocate capital will fall into three broad categories. There are growth assets, there are inflation hedges, and then there are deflationary hedges. Growth assets are simply those investments that are intended to earn returns in excess of less risky assets like cash or bonds. Growth assets may include things like listed shares. They can cover developed and emerging markets and sometimes even frontier markets. Some LPs may also have specific targets for equity, such as small caps versus large caps and value versus growth. And growth assets may also include unlisted privately held shares, such as private equity firms or buyout companies. VCs also fall into this category as well. Now, hedge funds are often part of the growth assets category. Not only do they invest in publicly traded equity and debt capital markets, but they're mandated to use derivative instruments to leverage their market exposure. Now, inflation hedges are investments meant to protect against the decreasing value or buying power of a currency as a result of inflation. So in an inflationary environment, they would be expected to generate a return higher than what the inflation rate is. Often inflation hedges would include classes of assets like property or commodities, things like gold, silver, other precious metals or natural resources, agriculture assets, oil. Those types of things will fall under inflation hedges. And then deflationary hedges are supposed to protect when asset prices actually start dropping, when the purchasing power of a currency increases. And to take advantage of this, LPs often hold some portion of their assets in bonds and cash to guard against unexpected deflation. Now, depending on the overall return target the LP is trying to achieve and their time horizon over which they're willing to tie up their capital, the LP constructs an asset allocation. And from that mix, they marry what they're going to deploy their capital towards.